Look, I want you to imagine something for a second. You've got $50,000 saved up. You've read all the books, listened to all the podcasts. You know your optimal asset allocation is 80-20 stocks to bonds. You've calculated that you should max out your 401k, then your IRA, then your HSA in that exact order to minimize your tax burden by 0.3%. You've even figured out which specific index funds have expense ratios that are 0.02% lower than the competitors. You are optimized. And then your car breaks down, $3,500 to fix it. But wait, you can't just pull that money out because it's all locked up in tax-advantaged accounts, or it's invested in assets you'd have to sell at the worst possible time, or accessing it means triggering a taxable event that destroys your perfect tax strategy. So you put it on a credit card at 22% interest. Congratulations, your optimization just cost you way more than you saved. My name is Elon Musk, and I spend way too much time thinking about why smart people make terrible financial decisions. If you're someone who's done everything right with your money but still feels one emergency away from disaster, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Because here's the thing, and this is gonna frustrate some of you, most financial advice is actively making you less financially secure, not more, less. Let me explain. The financial advice industry has sold us this idea that personal finance is an optimization problem. Like if you just find the right combination of investment accounts, the perfect asset allocation, the ideal savings rate, and the most tax-efficient withdrawal strategy, you'll win the money game. And look, I get it, optimization feels good, it feels smart, it feels like you're doing something. But here's what most people don't realize, optimization makes you fragile. Let me show you what I mean with some actual numbers, because this is where it gets really interesting. There was a study published by the Employee Benefit Research Institute in 2023, and they found that 57% of Americans couldn't cover a $1,000 emergency expense with cash. 57%, more than half the country. Now you might be thinking, well, those are just people who aren't saving at all. Wrong. The Federal Reserve's survey of household economics actually found that 37% of people who consider themselves good savers, people with retirement accounts, people who are investing, still couldn't handle that same $1,000 emergency without going into debt. How is that possible? It's because they've been taught to optimize for the future at the expense of the present. Every dollar has a job, every account has a purpose, everything is allocated and assigned and locked away where it can grow at the maximum possible rate. Here's a real example. Let's say you're 30 years old. You make $75,000 a year. You read that you should save 15% for retirement, so you're putting $11,250 annually into your 401k. You're contributing $7,000 to your IRA. You're putting $300 a month into $529 for your kid. You calculated that by doing this, you'll have $2.1 million by age 65, assuming a 7% return. Perfect, right? You're on track, you're optimized. Except you've got $1,800 in your checking account right now. That's it. Your emergency fund is technically $5,000, but it's in a high-yield savings account that takes 3 business days to transfer, and psychologically, you don't want to touch it because you're proud of that $5,000. You worked hard for it. Then your kid needs braces, $4,200. Not an emergency exactly, but not optional either. What do? Most people in this situation, and I've seen this hundreds of times, they don't pause their retirement contributions. That would feel like going backwards. They don't touch the emergency fund because that's not what it's for. So they finance the braces at 9% interest, or they put it on a credit card they'll pay off soon. And just like that, your optimization cost you real money. Because here's the math. You're paying 9% on $4,200 while your 401k might be earning 7% on that same money. You're going backwards. You would have been better off just not optimizing. Now look, I know what some of you are thinking, but Elon, you're supposed to have an emergency fund for exactly this reason. Sure, theoretically, but here's the psychological reality that nobody talks about. Optimized systems require perfect execution. They require you to never make a mistake, never have an unexpected expense that's bigger than your emergency fund, never lose your job, never have a medical issue, never have a family crisis. They require you to be a robot. And you're not a robot. You're a human being living in an unpredictable world. This is the core issue. The financial advice you've been getting is designed for a world of perfect information and perfect execution. It's designed for a spreadsheet, not for real life. Let me tell you about resilience instead. Resilience is the opposite of optimization. Well, not the opposite exactly, but a fundamentally different approach. Optimization asks, what's the absolute best possible outcome if everything goes according to plan? Resilience asks, what's the range of outcomes I can survive, and how do I make that range as wide as possible? Here's a concrete example of what this looks like in practice. Let's take two people, both 35 years old, both making $80,000 a year. Person A, $0 in accessible cash savings, $30,000 in 401k, $15,000 in IRA, $8,000 in HSA, $2,000 in 529. Total $55,000 net worth. This person followed all the rules, maxed out the tax-advantaged accounts first. Every dollar is working hard. Person B, the resilient one. $15,000 in a regular savings account, liquid, accessible. $20,000 in 401k, up to employer match. $10,000 in a regular brokerage account, taxable but accessible. $8,000 in IRA. Total $53,000 net worth. Person B has $2,000 less on paper. They've lost years of tax-advantaged growth by keeping money accessible. Now both of them lose their jobs. Person A is in immediate trouble. They've got maybe $3,000 in their checking account. That'll cover 1 month of expenses, maybe 2 if they're extremely careful. To access their $55,000, they'd have to either take early withdrawal penalties or worse, take out loans against their 401k. They're forced to take the first job offer they get, even if it's not a good fit, even if it pays less. Person B, they've got $15,000 liquid plus another $10,000 they can access within days with no penalties. That's 8-10 months of expenses if they're careful. They can be strategic. They can wait for the right opportunity. They can negotiate. They might even be able to start that business they've been thinking about because they have runway. Here's what really matters. When person B does find work again, they immediately rebuild that resilience cushion. It's not wasted money sitting around doing nothing. It's optionality. It's freedom. It's the ability to make good decisions instead of desperate ones. And here's where the data gets absolutely wild. Chase did this massive study in 2022, analyzing actual banking data from 5 million customers. They found that people who maintained higher liquid savings, meaning cash they could access immediately, actually ended up wealthier over 10-year periods than people who invested more aggressively early on. Wait, what? How is that possible? Because life isn't a straight line. The people with accessible money didn't have to sell investments at losses during emergencies. They didn't rack up high-interest debt. They could take advantage of opportunities, buying a house when the market dipped, investing more when stocks crashed, taking a career risk that paid off. They had better returns on paper, but they kept having to break their own systems. And every time you break the system, sell investments early, take out loans, use high-interest debt, you're not just losing money, you're losing momentum. There's actually a term for this in engineering, graceful degradation. It means a system that doesn't catastrophically fail when something goes wrong. It bends instead of breaking. Financial resilience is graceful degradation for your money. Now I can already hear some of you shouting at your screens. But Elon, you're leaving money on the table. That cash is getting destroyed by inflation. I'm losing 3% a year just sitting there. Okay, let's talk about this, because yes, there is an opportunity cost to liquidity. If you keep $20,000 in cash earning 4% in a high-yield savings account instead of invested earning potentially 10%, that's about $1,200 a year in foregone gains. But here's what you need to understand. That $1,200 isn't wasted. It's insurance. It's the premium you pay to not make expensive mistakes. Think about it like this. You pay $1,500 a year for car insurance, right? You don't think of that as leaving money on the table. You recognize it as protecting yourself against a catastrophic downside. Financial resilience is the same thing, that liquid savings. It's insuring you against forced selling, against high-interest debt, against having to make career decisions out of desperation instead of strategy. And here's the thing that really blows my mind. People will pay $1,500 for car insurance to protect against a risk that might happen, but they won't keep adequate liquid savings to protect against financial emergencies that are guaranteed to happen. Because emergencies aren't a question of if, they're a question of when. Let me give you another real-world scenario, because this is where the rubber meets the road. It's 2020, COVID hits. The market crashes 34% in 5 weeks. You've got $100,000 invested, so suddenly you're looking at $66,000. If you're optimized, meaning fully invested with minimal liquid savings, what happens? You panic. Maybe you sell some positions to preserve what's left. Or you can't contribute more because you don't have the liquidity, so you miss the recovery. Or you have an emergency during this time and you're forced to sell at the absolute bottom. But if you're resilient, if you've got $30,000 liquid, you're calm. Actually, you're excited. This is a buying opportunity. You dollar cost average $10,000 into the market over the next few months while it's down. When it recovers, you didn't just avoid losses, you actually profited from the volatility. This actually happened. Vanguard did a study of investor behavior during the 2020 crash and found that investors with higher cash reserves earned returns that were 2.3 percentage points higher annually over the following 3 years compared to investors who were fully invested at the start of the crash. Why? Because they could be rational when everyone else was panicking. They had the cushion to make good decisions. All right, so what does this actually look like? How do you build financial resilience instead of just optimizing yourself into a corner? Here's the framework I recommend, and this is based on both the research and just watching thousands of people either succeed or struggle with money. Step 1, build your opportunity fund first. Not your emergency fund, your opportunity fund. I want you to have 6-12 months of expenses in boring, liquid, accessible savings. No, it's not earning 10% returns. Yes, it's the money move you can make. Why? Because this isn't just for emergencies, it's for opportunities. That dream job that pays less at first but has huge upside, you can take it. That house that comes on the market below value, you can move on it. That chance to go back to school or start a business, you can actually consider it instead of immediately dismissing it because you can't afford the risk. Step 2, get the employer match, nothing more. If your employer matches 4% in your 401k, contribute 4%. Don't contribute 15% until you've built that resilience cushion. The employer match is free money, take it. But beyond that, you're better off building flexibility first. Step 3, use taxable brokerage accounts. I know you're leaving tax advantages on the table, but you know what? A taxable brokerage account is accessible. You can withdraw from it without penalties. You can use it to buy a house, start a business, bridge a gap between jobs. This is what wealthy people actually do, by the way. They keep significant assets in accessible accounts because they understand that optionality is more valuable than tax optimization. Step 4, only then maximize tax-advantaged accounts. Once you've got 6-12 months liquid, once you're getting the match, once you've built some accessible investment accounts, then go back and max out those IRAs and 401ks and HSAs, because now you can do it without making yourself fragile. Here's the deeper principle behind all of this, and this is really what I want you to walk away understanding. Personal finance isn't actually about money, it's about options. Every dollar you have gives you an option. Will you exercise that option? Maybe, maybe not, but having the option is what matters. When all your money is locked up in optimized accounts, you've traded your options for marginally better returns. You've traded flexibility for efficiency. You've traded resilience for optimization. And the brutal truth is, in real life, flexibility beats efficiency every single time. There's a reason why billionaires keep millions in cash even though it's inefficient. It's not because they don't understand investing. It's because they understand something more important. The ability to act when opportunities arise is worth more than the returns you miss by waiting. What I'm asking you to do here is make a fundamental shift in how you think about money. Stop asking, how do I squeeze out every last percentage point of returns? Start asking, how do I build a financial life that can withstand whatever comes at it? Stop asking, what's the optimal allocation? Start asking, what range of outcomes can I handle, and how do I expand that range? Stop asking, how do I minimize my taxes this year? Start asking, how do I maximize my options 10 years from now? This is the shift from optimization thinking to resilience thinking. And once you make this shift, everything changes. You stop feeling anxious about money even when you're doing everything right. You stop feeling trapped by your financial decisions. You stop making desperate choices because you've backed yourself into a corner. So here's what I want you to do right now. Pause this video and look at your own financial situation. Ask yourself, if I lost my income tomorrow, how long could I survive without going into debt or breaking my financial systems? If the answer is less than 3 months, you're optimized but fragile. You need to build resilience first. Here's your homework. 1. Calculate your true monthly survival expenses, not your lifestyle expenses, your survival expenses. What do you absolutely need? 2. Multiply that by 6. That's your resilience target for liquid savings. 3. If you're not there yet, redirect money from aggressive investing into building that cushion. Yes, even if it means temporarily reducing your 401k contributions below the recommended 15%. 4. Once you've hit that target, then go back to optimizing, but not before. Look, I get that this advice goes against everything you've been told. I get that it feels wrong to have money just sitting there. I get that every financial calculator on the internet is going to tell you you're making a mistake. But here's what I know after years of studying this stuff and watching real people navigate real financial lives. The people who build resilience first are the ones who actually build wealth. The people who optimize first are the ones who end up starting over every time something goes wrong. Financial resilience isn't about having the most money. It's about having money that works for your actual life, not some theoretical perfect scenario. It's about being able to sleep at night knowing that if something goes wrong, when something goes wrong, you're not going to lose everything you've built. It's about having the freedom to make decisions based on what's best for you, not based on what you can afford to do right this second. That's worth more than 0.3% in tax savings. That's worth more than the optimal asset allocation. That's worth everything. If this resonated with you, hit that subscribe button. Drop a comment and let me know, are you optimized or resilient? And what changes are you going to make? I'll see you in the next one.